Okay, thank you so much for joining us in class today. So we are happy that at least one person was able to take the advantage of coming to class. Let me first of all assume that you have listened to the little voice notes. Okay, let me share my screen with you so that you will see the notes we are using for today. Okay, sorry. Okay, this is the note we are using for today. So we talked about the last time, we talked about taxation of business income, and we spoke about basis period for assessable profit. We will now be looking at basis period for capital allowance, and we will now see how we can handle capital allowances. Okay, let's use question number 1 to explain. But meanwhile, we'll be coming to this chart to see our capital allowance rates. So let's go straight to question number 1 and let's discuss it. Okay, so let me keep it so that I'll be seeing when people come in. All right, James Nigeria Limited. Now, this is a company by the word limited. Commenced business, so commencement rule is what is following here. As a textile manufacturing company on 1st of June 2001. This date is relevant for commencement because you will use it in your basis period for the first year and for the second year. Even though it was incorporated on March 15, 2001, this date for now is irrelevant. Its account for the first few years of its operation showed the following adjusted profits. So these are adjusted profits. Once you see adjusted profits, you'll be seeing things like year end, or you may see year of assessment. But when you see year of assessment, they will give you other things you use to adjust it. When you see year end, it may just have just the figures for the year end or period end. So now when you see period end, it means here that it is not exactly 12 months. It's either less than or more than 12 months. So you can see this is 10 months and ending on March 31st. Then we have year end. Year end is a complete year. We have another year and a complete year. We also have the company incurred the following qualifying capital expenditure. That means they spend this thing on capital expenses. Now we see the one they spent in March 2001. Now, what is significant about this is that the business has been incorporated, but it has not started operation. So what they did was that they registered their business with CAC. Then maybe 10 days later, they went to buy a factory building. Then maybe in the month of May, before the business started, they went and buy machinery. This is in order because there's no way you can get all of these on the day you start business. So you must have acquired them before the business started. Fine. Now we have furniture, October of that same year. It's understandable. Then we now have delivery van, February. Perhaps before they were hiring van. Now they now have their own delivery van. Then they now got their own motor car on May 2020 and 2002. Then there is office equipment. Maybe before they were using manual hand and recording system and all that. So now maybe they now got computers and all that to put in the office. These are qualifying capital expenditure. Now, we are told here to determine the basis period for assessment. That means this is basis period for profit and basis period for capital. So how do we do it? For the first 5 years, this is what we shall do. Okay, so here's the solution for the first 5 years. What we do is we'll open a table like this, but we'll be treating them column by column so that you understand. But you need to write these headings first. Year of assessment is needed. Then the basis period for profit is needed first before you now do basis period for capital allowance. So you see, that is the sequence they asked the question. And that is the sequence you should also follow. Do that of profit first, then you do capital allowance, because capital allowance must follow the sequence of profit. Then look at the qualifying capital expenditure that we spend that we'll be claiming capital allowance on. So since they say for first 5 years, what are the 5 years that we need? The way to know the 5 years we need is the word here, commenced business. So it starts from the date of commencement. What is the date of commencement? June 2001. So this makes 2001 the first year. So if you have gotten 2001 as your first year, that automatically means 2002 is the second year, 2003 is the third year, this is the fourth year, and this is the fifth year. So we have finished with this column. Now, how do we treat the basis period for profit? So you know from what we said before in the previous class that in assessable profit, the basis period is from the date the business 31st of that same year. So that's what we did here. The date the business started, June 1, 2001 to December 31st, 2001. That's it. The second year will be from the date the business started, and we will count 12 full months. How do we count our 12 full months? We know that this is June 1 here. So what will be the ending dates? It will be, look back to yesterday. That means if today is June 1, yesterday was May 31st. And when you have written May 31st, if this is 2001, bring 1 year forward, 2002. So it is May 31st, 2002. That's fine. Now, the 2003, the third year, is supposed to be on preceding year basis. If 12 months on preceding year basis, we will still follow our preceding year basis, but we are going to look at 2003. That means your ending must be 2002. Now, what date are they bringing their account? March 31st every year. We have a problem. This business started in June, and March is higher up in the calendar than June. We will have a problem. If it was May 31st, we will not have too much of a problem. Now, the thing here is this: whenever the date of bringing the account, or making up the account is higher up in the calendar than the date of commencement of business, whenever it is higher up, you will repeat the second year for the third year. Now that's the principle. Whenever there is the date they bring the account for reconciliation or for accounting or for filing as in March 31st is higher in the calendar than the date the business started, you will repeat the second year for the third year. That is the observation. So you see, that will mean that January, if it was January, they bring it, or February, or March, or April, or May, you will repeat the second year for the third year. That's fine. But if it is anything like from June downwards to the calendar, ending of the calendar, you will do preceding year basis 12 months without repeating the second year for the third year. So if you look at it, this is March, and so there's no way we can achieve 12 full months here if we do preceding year basis and put March. That would mean that it will now start from February to 1 when the business has not started. So you see, we must repeat the second year for the third year. So the principle is whenever the date of accounting is higher up in the calendar than the date the business starts, the second year gets repeated as a third year. That's the principle. So that's why we are repeating it here. Now, for the fourth year, you will now do the normal preceding year basis as we normally do. So this is 2004. The preceding year must be 2003. That's fine. Then if they are bringing the account on March 31st, you put your March 31st, 2003. That would mean that, of course, what you do is you will ask yourself, what is this account beginning? If this is March 2000, March 31st, ask yourself, what is tomorrow's date? Tomorrow's date will be April 1, 2002. So that means April 2002 is the beginning of the period, ending in March 31st, 2003. So every other one will be starting with April and ending in March. So all you need now do is for 2005, this is 2002 here, you change to 2003, 1 year. Here is 2003, you change to 2004. So it's just a simple copy and paste and changing the dates, the year. That's fine. We've seen that of profit. Now let's go to capital allowance. For capital allowance, what we should note here is that capital allowance does not allow for overlap or for gap, but accessible profits can allow for overlap and for gap. If you see overlap here, there's an overlap in the first year with the second year. Then there is a complete overlap between the second year and the third year because it was repeated exactly. And there is an overlap between the third year and the fourth year, but there is no overlap between fourth and fifth year. How will capital allowance handle this? Capital allowance says that when there is overlap, the overlap belongs to the first period. When there is a gap, the gap belongs to the second period, except on cessation rule, where both overlap and gap belongs to the first period, and that first period happens to be the penultimate year. So you see, when there is an overlap or gap in cessation principle, in cessation rule, both overlap and gap will belong to the penultimate year. It doesn't affect ultimate year. But in every other case, when there is overlap period belongs to the first. When there is a gap belongs to the second. That's the principle. Now look at this, that of capital allowance. Since this is the first, it will always follow the same thing with profit because nothing has existed before. So capital allowance will normally start where profit starts and end where profit ends. Now in the second year, we find out that here there is an overlap between these 2 years. So what is the overlap? You may need to check what the overlap is. So there is June 1, 2001. You can still find June 1, 2001 showing there's an overlap. But when you look at 31st May 2002, you cannot find it here because this is where the account ends. You cannot find it inside this account. So that means there are some parts that did not overlap and there are some parts that overlap. So this ending part did not overlap. So you repeat it here. The ending part did not overlap. But this beginning part overlapped. You cannot repeat it. So what do? For you to bridge the overlap and to ensure that there is no gap, go to where this one ends, because this one here ends the same place that this one ends. So go to where it ends and ask yourself, what is tomorrow's full date? If this is 31st December 2001, tomorrow's full date is January 1, 2002. That is where this will start. So you see, January 1, 2002 is inside here also. Now, this basis period we just did here is only for capital allowance. Mind you, it's only for initial allowance. Only for initial allowance. What this thing is telling you that it is this same basis period that is used, this basis period for profit, that is the same basis period that is used for annual allowance. But for capital, for initial allowance, you use only this basis period. The reason is this: if you buy an asset in a period of overlap and you are charging initial allowance is charged just once. Where will you charge it? You will charge it just once. And so for you to charge it just once, you must remove overlap and you must remove gap. Because if you buy the asset in a month of gap and you don't bridge the gap, you will end up not charging your initial allowance. So it is only for initial allowance this capital, this basis period is being used for. But the annual allowance we know is 12 months. Okay, now that we've done here, we'll go to the third year. The third year is an exact overlap of the second year. And if it is an exact overlap, that means you cannot do anything because the beginning, you can find it here. The end, you can also find it here. So there is nothing you can do here. So that means any asset bought within this period has been taken care of by the second one, by the second year. So it cannot be taken care of again by the third year. That doesn't mean that annual allowance will not come here. This factory building will have its annual allowance here. It will also have annual allowance full here. Delivery van will also have their annual allowance here. All of them will also have annual allowance here, but there is no initial allowance. Now go to the fourth year. What do? This is April 1, 2002. Can we find it inside here? Yes. So this account is June 1, 2001 is farther than this. So, but look at the ending, May 2002. We can find April before May. That means there are 2 months of overlap. There is April and there is May. So there is overlap of 2 months here. So you cannot start with this date. Now, look at this date ending of 31st March 2003. You cannot find it anywhere in the preceding. So it means you can end your capital allowance with this. So how do you now start? All you now look at is go to the previous one and ask yourself, what is tomorrow's full date? If this is May 31st, 2002, the next day is June 1, 2002. That is the basis period for the 4th year. Now go to the 5th year. This date here, you cannot find it anywhere here. Then you ask yourself the second question, is this date the next day after this? If it is true, then there is no overlap and there is no gap. Then you start your date with this and you also end your date with this. So as long as these dates keep continuing in this same format, the capital allowance will continue in that same format. Then you go to the qualifying capital expenditure and look at the dates that they were bought. This factory building was bought on March 15, but here you can see that there is no March 2001 here. It starts from June. What does it mean? It means that the business started in June, the factory building was acquired before the business started. Even this machinery was acquired before the business started in May. What it means is that any asset you bought before your business starts is deemed to be purchased on the first day of the business. So we can even say that this factory building and machinery were deemed to be bought on June 1. So that's why we're seeing them here. Then this furniture that was bought in October 2001 is still here. Delivery van was bought in February, is it February 2002? Yes, February 2002. And motor car was bought in May 2002. So you can see that February and May are all covered here. Then the office equipment was bought in, is it January 2003? Yes, so you see that January 2003 is inside here, it is covered here. So that's how you do your table for this first question. And I believe this is clear. So let's go now to the second part of the question. It says here, compute the capital allowance due for 5 years of assessment in respect of the capital expenditure incurred by the company. So we're talking about that same 5 years period. So what we are going to do now is we are going to do some similar table. We will bring this year of assessment heading. We will not bring this basis period. All we will need to do is we'll bring this basis period. We will now bring this and we'll now, let's see what we'll do. So this is the only place that we'll go off. This is because we don't really need this now. What we need is this basis period so that we can calculate our initial allowance. That is why we need this. Okay, so see what we'll do now. This is the table I was telling you about. So what we now do is, this is copy and paste from last table. This is copy and paste from last table. This qualifying capital expenditure is copy and paste from last table. So no need discussing these first 3 columns since we've talked about them in the last table. In the next table, these next 3 columns are what we discuss. So, you know, this basis period was because of calculating initial allowance. That is why we did it. So we are going to look at how we are going to calculate the initial allowance. And in fact, with that annual allowance, it is also used for annual allowance. This basis period we did here is also used for annual allowance for the first year only. So you see, for initial allowance and also for annual allowance for the first year only. The second year only will be giving them, the second year will be giving them full allowance. Only the first year want to see how we will prorate. Okay, so let's go and see how we make a table. Okay, we get to workings now. Now look at the workings for initial allowance. So how did we do it? The factory building, we told you before that factory building or industrial building, initial allowance, industrial building initial allowance is 15%. And so you see us using 15%. What is the cost of the factory building? The cost of the factory building is 3.5 million. And so we use 3.5 million, 15% of it will give me 525,000. And that is why we have our 525,000 as our initial allowance. We are not prorating initial allowance. Initial allowance is taken full, even though you use it just one day on the basis period. Even if it is the last day of the basis period, you use it, it is charged full. So that is how we will do our factory building. The same thing for machinery. We'll look at the machinery for that year is 50% of the cost. If you go to the machinery, plant and machinery, you see it's 50%. So that is what we did. 50% of the cost will give you 1.4 million. So 1.4 million is what is here. So the same thing we do for furniture, and we get our figure. So when we get our figure, which is this furniture, you add these three together and you have your full and initial allowance for that year, for all the assets in that year in the business. Now that's initial allowance. Now let's look at annual allowance for that year. How do we get our annual allowance for the first year? Now, if you look at what we wrote here, factory building and machine were deemed to be purchased on June 1. That is important in getting our annual allowance. So in factory building, what we did was that, did you see that this is our cost as shown here? This is our initial allowance as shown here. So you say cost minus initial allowance. What would that give you? To give you a figure, let me see if I can bring my calculator and do one. Okay, it's hanging. So you say cost minus initial allowance will give you a particular figure. Sorry, calculator is trying to come up. Hold on a moment. Okay. Calculator is booting. It has come up now. So your cost is 3. Why am I having two calculators now? Okay, your cost is 3.5 million. Now you now less your initial allowance, 525,000. What you have is 2,975,000. That is your numerator. Now what is going to be your denominator? Your denominator is going to be the number of years. So if you look at what we did here, cost minus initial allowance divided by the predetermined number of years. This predetermined number of years is taken as n, the number of years. How do we get our N? Our N is our 100% divided by annual allowance rate. And so 100% divided by non-industrial building. Okay, so the industrial building is annual allowance rate is 10%. So you say 100 divided by 10. So when we do 100 divided by 10, it's as good as saying it's 10 years. It's 10 years. So we will now say 292,975,000 divided by 10 years. It means that you are going to be charging 297,500 every year for 10 years for this figure to be finally cleared. That means every year, year one, you will charge this, year two, you will charge this, year three, you will charge that figure. But we have a problem. Annual allowance is prorated for the number of period it is being used. Most businesses, what they do is that they prorate it by number of months used. While some who wants to be very precise will use number of weeks or number of days. So if you are using number of days, you need the date it was bought. If you are using number of weeks, you need the week it was bought. You divide by 52 weeks. If you are using number of days, you now divide by 365 days. But now if you are using months, you are going to divide by 12. So that is why in our formula we assume months, we use M, the number of months used in a year, divided by 12. So that's what we are going to do now. This factory building was deemed to be bought on June 1. So you see our basis period here shows our basis period here. Where is our basis period here? It shows June 1 to 31st December 2001. So we are going to count how many months it is. It's 7 months. It means that we use this asset for 7 months. So instead of charging this full amount for that first year, we are going to divide it and give it 7/12 of it, which gives us 173,542, which is what we put here. 173,542. That is the annual allowance for the factory building. The same method goes to machinery. This is the cost. This is the initial allowance, numerator. The annual allowance is 100 divided by the annual allowance rate of 25%. So if you can see it here, is this 25%. It gives us 4 years. So when you do this arithmetic, 1/4 at the beginning, 4 years at the end, you have a full rate, a full annual allowance figure of 350,000. That is what you will charge every year. But you can't charge this on the first year. You have to prorate it by 7 months out of 12, and you have 204,167, which is exactly what we have here. Now that's fine. The third one happens to be furniture. Is the same way we are doing it, and this is the annual allowance rate, which is 20. Furniture is 20. So if furniture, office equipment, okay, furniture and fittings, this is 20. 20 years, 5 years. So all we need to do here is you divide by 5 years. So when you divide by 5 years, this is what you will get as your full annual allowance rate for full 12 months. But you see, furniture was bought in October. From our question, it was bought in October. And if you look at our basis period ends here in, our basis period ends here in December. So it means it was used in October. If it was bought, even if it is 31st of October, it was used in October, full October, November, and December. So 3 months, it was used in 3 months. So we will now use 3/12. That's how we got this figure, which is the value we have here. So when we add all of them together, we have this annual allowance total rate for the first year. So all we need to do is you add your initial allowance plus your annual allowance to give you your total allowance, total capital allowance. That is how we got these rules. Now that we've done for the first year, let's go to the second year. Now let's see how we do the second year. Second year initial allowance is easy. All you need to do, you find the initial allowance rate, which is 50%, multiplied by the cost, you have your annual allowance. That's fine. Motor vehicle, motor van, delivery van, all are the same 50%. Find 50% of the cost, that is your answer. That's what we did here. We now get these two figures, add them together to give. Now, annual allowance is where the issue is. Now, annual allowance is the same thing we did. This year, 2002, is the first year that you are using delivery van and motor van. So for these two assets, these are their first year. But for these assets that you bought in 2001, when we get to 2002, it will be their second year. So we have first year assets and second year assets. So the first year assets are the assets bought in 2002. So what will we do? We'll look for the cost of the asset minus the initial allowance like we did before, then look for the annual allowance rate, which is 25%. 100 over 25 is 4. So we'll now say 250 divided by 4. We have this figure. Like we do for all assets in the first year, we prorate the first year. We use the asset in just 4 months in the basis period. This was because this asset was purchased in February. And because it was purchased in February, and this is May, that is ending the basis period. So we say February is 1, March is 2, April is 3, May is 4. 4 months out of 12 months. So we use 4 over 12. And that means this is the amount we shall prorate for the first year. So if we go to our answer, this is this thing we're talking about. Then we go to the second asset, which is motor vehicle. We know that this minus this is 1 million, is 600,000. Now, we also know it's going to be 4 years. So when we divide it by 4, we have 150,000. We now have to prorate it for 1 month out of 12 because this car was bought in May. And because it was bought in May and the basis period is also May, ending in May, is used for 1 month. So you say 1 over 12 and you have 12,500. Now that's also what we did here. Now what is this 760 all about? Where did we get it? It's simple. These second year assets will also have annual allowance. This is asset bought in 2001. I call them second year allowance because in 2001 we got their first allowance, which are all these here. But now we want to use their second allowance. We're not going to be prorating again. So we're going to give them their full figures. So what we now did was that this was the full annual allowance for factory building before we prorated. This was for machinery before we prorated. This was for furniture and fittings before we prorated. And when we add them together, we are getting that 760, which we have here. So no need come and write all these assets again. It will be as writing these assets again would be as though you bought them again. So you can just simply say assets bought in 2001. You can write it here. Assets bought in 2001. You can write it with biro. Then you come to initial allowance, you can put dash. Annual allowance, you put this figure. So when you total them, you have this figure. And you know how to get this total capital allowance figure is the sum of these two. Now going to 2003, when we have nothing, we will not have initial allowance because no asset was bought, but we're going to have annual allowance. This is because these assets will have their annual allowance again. So you'll be seeing 760 featuring again. Not only that, these ones will also have their full annual allowance given to them. That is what, when you add them together, it gives you 972,500. So see where it's been done. If you go to 2003, that is how we got our 972,500. We did for asset purchase in 2001. We did for asset purchase in 2002, the full figure, and it gives me 972,500. That's simple. That is what we put here, and that is what's going to be our capital allowance. Now going to 2004, we found out that we bought an equipment. This was bought in January. And if it was bought in January and this basis period is ending in March, how many months does it use? 3 months. So it means that after getting our initial allowance, which we know how to get, okay? Look at the initial allowance, which we know how to get. This is 4 years, and we get this. Sorry, this is our initial allowance for equipment, 300. Where did we solve it? This is it. This is where we solved our initial allowance for equipment, 300, which is what we got here, straight. An annual allowance. This is where we solved the annual allowance. Now, when we solve the annual allowance here, we got 75,000, which we are going to prorate for 3 months, January, February, March, and you got 18,500. And when you put your 18,500 as prorated, remember all these assets bought in 2001, 2002. Remember when you were doing 2003, you brought all of them as 972,500. In 2004, they will still be coming again as 972,500. So when you add these two, you are getting this value. So when you add this value to this value, you are going to get this value. Now going to the assets for 2005, there is nothing bought in 2005. So there will be no initial allowance because no asset was bought there. But how did we get these figures? Is because of this figure we are going to use here plus the full charge of equipment. So let's see it here. For 2005, can you see it here? This was asset bought in 2001. This was asset bought in 2002. I will add, will give you 972,500. And this is the 75,000, which is the full charge. We are charging it full here. So when you bring everything together and you add them, you are having this figure as your capital allowance or annual allowance. So you see it here. That's the figure here for annual allowance, and that's the same figure for total capital allowance, investment allowance, and initial allowance. So we have seen how to do your capital allowance. The next question here says compute the tax liability. for the first 5 years. So we are using the first 5 years of assessment. So what we will now do, we will now visit this table again, but this time, since they say tax liability, we'll be using this basis period along with this year of assessment. So if you see what I did for year of assessment, each time you see year of assessment, I will put a bracket, I will bring this basis period. I will ignore this because this basis period and capital allowance has been done for us using this part B, and we got our answer. So this is the figure. Each time I mention capital allowance, this is the figure I'm going to use. So what we are saying is that for this year of assessment, this is the capital allowance figure I'm going to take. The same thing, corresponding year of assessment, corresponding capital allowance figure. So because we are talking about tax, you know you have to compute your tax from basis period for accessible profit. So these are the profits basis period I'm going to use. So now let's see answer. Sorry. Now look at the first year. Now the first year accessible profit. Look at the basis period we use is 7 months, and accessible profit was given to us as 7.5, and this is 10 months. But we know our basis period is 7 months, so we're going to take 7 out of the 10 months. So that's exactly what we did, and we did 7/10 of that figure, and we have this 6,297,500. Pretty good. Now let's look at capital allowance figure. When we say capital allowance figure, we are taking it straight from, we are taking capital allowance figure straight from here. So we're taking this capital allowance figure straight up. That's fine. So when we do that, with less capital allowance from profit figure, we have our taxable profit. It is from here we will look 30% of taxable profit for us to get this company income tax. Then when doing education tax, you do 2% of your accessible profit always. That will give me this. Okay, now the next year, somebody's asking question. Please, sir, how did we get the 7 months? Calculate now. This is 1st of June to 31st of December. How many months is it? It's from the basis period. How many months? Count. We'll count June, because from June 1 to June 31st or June 30th is 1 month. Then we'll count July. We'll count August, September, October, November, December. 7 months. So that's the 7 months. Okay. Now in the year 2002, it is from June 1 to 31st May 22. So this is a 12 months figure. So we must use 12 months. So, and it's also starting from the date the business started. So if you look at the date the business started, they gave us a 10 months figure from the date the business started. We are going to take this full 10 months. But since we need 12 months, we are going to get our remaining 2 months from here. So all we need to do is we'll say 2/12 of this figure to add to what we have in the 10 months. So that's exactly what we did here. Look at the 10 months figure that was given to us, and look at how we did our 2 months out of 12. So you do this first, 2/12 times 12,000, you get 2 million. Whatever you get, you add it to this. Don't make the mistake of doing this one, then I say plus, then I say 2/12 times, you get a different figure. Always tidy this one first, the one that has the multiplication, then you come to the one that has addition to join them together. So that's 9.5 million. Then you take your capital allowance figure, which is this figure, and you bring it down here. You less it to get your taxable profit, which is used to compute tax, 30%. Your education tax is 2% of assessable profits. Then we'll go to the next year. The next year is sorry. The next year is a complete. Okay, if you look at what we did, it's a complete. What do I call it? It's a complete overlap of the second year. If it is a complete overlap of the second year, which you remember, we repeated the second year for the third year. So because we repeated the second year for the third year, we are still going to do assessable profit, the same thing exactly as we did in the second year, because it is the same basis period for the second year which we repeated for the third year. Now we'll get the same answer here. We'll also still get the same education tax answer, but our capital allowance makes the difference. This is because in our capital allowance figure, this is the capital allowance we have for the third year, which is what we shall apply. And we have this taxable profit, which is what is the basis for tax for that year. Then we'll go to the fourth year. The fourth year is preceding year basis ending on account ending on March 31st, 2003. So if you look at March 31st, 2003 year ended, is still this figure. So we are using this whole figure, and we've taken that figure, and that's it. Taking the whole figure, then we are bringing the capital allowance figure there to adjust with it here. When we put the capital allowance figure there, you less it, you have the taxable profit from which you look for your tax. The assessable profit is the basis for your education tax, which is this. Then the fifth year, follow the same pattern. Assessable profit is going to be on preceding year basis, 18 million. Then capital allowance is brought from here, bring the capital allowance there, and you make use of it to get your taxable profit, which gives you your tax, and your assessable profit, which gives you your education tax. So you see, that's how we go when we do basis period for profits, basis period for capital allowance. So the step is get the basis, get the year of assessment from commencement of the business. So you look at the commencement year, that's your year one. You list all the years that you are given. Bring the basis period for profit first. Then applying the rule of no overlap and no gap, bring the basis period for capital allowances. Then look at the capital expenditure. Try to look at the date of purchase of each capital expenditure and categorize them under which year and which basis period they fall. Then you now look for the initial allowance, you look for the annual allowance, then you look for the total allowance. Then from there, you now look for the profit and assessable profit. You then look for the taxable profit by lessening it from capital allowance. Then you look for your education tax and you look for your company income tax. That's pretty easy. We are going to be seeing it more often. We'll go to question number 2. Question number 2 has to do with an asset that is an asset that was okay, hold on, let me get to it. Okay, so this is the question here, that this asset was, the company is engaged in business, and their business is incorporation and sale of new electric cookers. So this is a company, so it means company income tax is 30%. Now, they are not in commencement of business. They have been in business for some years. Been in business for some years. But now, the business is ceasing. So we are looking at cessation period. So the first question we did was commencement. And we see the principle of overlap and gap overlap. But now, we are now in cessation. And when we look at cessation, there is a different way we look at capital allowance. They didn't ask us to calculate capital allowance now in this question because you were given. But I want to tell you that when you get to capital allowance for cessation, whenever you are doing the penultimate year and the ultimate year, there must be gap in basis period of profit. The one that the revenue authority will accept. When they accept the higher one, there's always going to be a gap. So will there be a gap in capital allowance? No. The capital allowance must not have a gap. So that would mean that the capital allowance for the penultimate year is supposed to be bigger than 12 months because to accommodate all the gaps. So the capital allowance for the penultimate year is going to comprise of preceding year basis and actual year basis joined together. So it's going to be longer than 12 months. You might see it as 15 months, sometimes even 24 months. Let's say, for example, you are doing your company ending date is 31st December every year. And your penultimate year is 2008. That would mean that you would have taken your basis period to be January 1, 2007 to December 31st, 2007, right? Fine, that's going to be your profit for penultimate year. Actual year is going to be January 1, 28 to December 31st, 28. Let's say, for example, the preceding year basis was the one that was chosen. If the preceding year basis was chosen, that means January 1, 27 to December 31st, 27 was chosen. Now, what happens to 2008? Nothing. Profit there, it will be lost. That's why we took the higher one. So the authority preferred to forgo the lower one and take the higher one. So your ultimate year, which is 2009, will just be January 1, 2009. So if an asset is bought in 2008, you see, you would have missed it. You would have missed it. So what will happen for an asset that was bought in 2008? The law says the gap, if there is a gap, that gap belongs to the later period. So normally, it should have belonged to the ultimate year. But because this is penultimate year, we will stretch the penultimate year to cover the gap. So you see, because we've chosen preceding year basis, January 1, 27 to December 31st, 27, we are going to stretch it to enter January 1, 28, which is the actual year of penultimate year, to December 31st, 2008. So you see, the basis period for capital allowance to avoid gap will now be 24 months. Using this example I gave you, it will be 24 months. So you see, there's not going to be gap, and there's not going to be overlap. So see, this is how we adjust the overlap and the gap for cessation of business. And now, there's a reason for all these. Is because you want to claim all your capital allowances before the business ends. And now when the business ends and there are unutilized capital allowances, you carry them backward 5 years from the penultimate year. Because in the ultimate year, you have zero profit, zero tax, you have capital allowance which you cannot carry forward anymore. You now take them backward. So if you're in the ultimate year, taking them backward means taking them to penultimate year. So your first backward count is penultimate year. The second backward count is the year before penultimate year. So you'll be taking it back until you get to the 5th year. So now look at this company results here. If you look at the profit, the accessible profit was increasing. It was increasing up to a point, then it starts decreasing. It increased a bit here, it now decreased sharply. Then it started decreasing, and decreasing. And as it is decreasing, the capital allowance is not smiling. The capital allowance was here. Not all of them will be relieved here. Then it is increasing. It went down. Even as it is going down small like this, there are some unutilized capital allowances. And at the end, the company says balancing allowance, which is like another kind of capital allowance, after disposal of all the company's fixed assets, is supposed to be this. So this is like capital allowance on the year of cessation, which is 2008. We're told that the company ceased business on 31st July 2008. So that makes it the ultimate year. It makes 2007 the penultimate year. Penultimate year, we're looking at preceding year basis, which will end in 26, and which will end in 26, and the actual year, which will end in 27, December 27. Okay, now let's see what we are going to do here. The question is compute the income tax liability for 2001 to 28 assessment year, giving as much relief as possible. So what do we do here? I'll keep this page open here so that you will see what is happening when I'll be taking figures. What is happening here is that capital allowances always follow year of assessment. If we see in the previous example, I told you that the capital allowances are linked to the year of assessment. So don't look at basis period anymore. You look at year of assessment. This is the capital allowance for it. Okay, but assessable profit, they can give you year of assessment and assessable profit. If they give you that way, fine. That means if they give you 2000 here, it's 2000 year of assessment. You use it that way. If they give you 2001, it's 2001 year of assessment. Use it that way. But when you see year ended or period ended, then this is not year of assessment, it's year ended. You have to now change your year ended to year of assessment. So this is your basis period. And if this is your basis period, it means basis period ending in September 30th, 2000. Preceding year basis apply. It means your year of assessment is 2001. That is why it is ending in September 30, 2000. So if I were you, I would just come here and put year of assessment. I'll trace it here and put 2001. This one I have 2001, I'll put 2002, because when I'm looking at year of assessment 2001, I'll be taking this figure for 2000. When I'm looking at 2002 figure, I'll be taking this 2001 figure. But when I'm looking at capital allowance, when I'm taking 2001, I will come to 2001 because this is year of assessment. If I'm taking 2002, I'll come to 2002 because this is year of assessment. So note that difference. So now let's watch what we do. Now this is the solution here. So look at the basis period. This is 2001. Preceding year basis, the account is going to end in 2000. September 30th, 2000. So where will I get my assessable profit? I'll go to the assessable profit ending in 2000. And that is why I took my 1/8. That's my 1/8 here. Now, this is my capital allowance. Where will I take it from? I'll take it from the one that has year of assessment 2001. And that is this capital allowance I just took here. And that's it. Now we are going to write it under here instead of here because this company is into sale and incorporation of new electric cookers. They are not into manufacturing nor into agricultural business. And so if they are not into these two, we'll have to prorate their capital allowance. And the prorating of capital allowance is to use 70, is that 75%? Yeah, no. 2/3. 2/3 of accessible profit. 2/3 of accessible profit, or we call it 66 to 3rd% of accessible profit. 66 to 3rd% of accessible profit, or 2/3 of accessible profit. So I like to call it 2/3 of accessible profit. So what we'll now do is we'll now look at 2/3 of 1/8. If the answer I get is smaller than this capital allowance, then I will use the answer. If the answer I get is bigger than this capital allowance, then I will no longer use that bigger answer. I will use the capital allowance. So the rule is when you do your 2/3 of accessible profit, any answer you get, compare it with this. Choose the lower value. So when we did it here, we got 1, 2. Now we are writing the 1 to 2 places for some reason. First reason is because we want to know how much balance of capital allowance will be left after we have taken this 1, 2 out. 750 will be left. That means 750 will be carried forward after we have dealt with 1, 2 this year. Now this is where we are dealing with the 1, 2 this year. We are using it to reduce our profits so that we will now have a taxable profit of 600,000, which is from where we will get our income tax, and your education tax is going to come from accessible profit. So I will not be talking too much of income tax and accessible and education tax. So I'll just be concentrating on how we get our taxable profit, because we know how to calculate income tax, which is 30% of this. Education tax is 22% of this. So we'll not be talking it too much because we have been saying it over and over. So this 750 is what will be taken to next year to add to whatever capital allowance we have. So look at where we took it to next year. And what is the capital allowance for the next year, which is this 920. 920 was the capital allowance. So we add them together and we have this total figure. But before that, look at our profits. Our profit of 23 was for year of assessment 2002, but we are taking a figure ending in 2001. So you see, we have the figure ending in 2001. So that's why we took our 2,300. So you know the pattern now. We're looking at 2,300. So Now that you've gotten our total capital allowance of this, we will now do our 2/3 of 2,300,000. Let's see whether we'll get something smaller. I don't understand what you mean by recap for the first year. Is it the capital allowance for the first year? Okay. This first year 1/8, we got it from here. This 1/8 here. Right? This capital allowance here, we got it from here. Now, we are saying that we cannot clear all the capital allowance because the business is such that there must be a restriction on how much capital allowance we are going to clear. As I said, you should listen to that voice note I sent. If you have listened, it is very clear. Now, because this business is not agriculture business or manufacturing business, we must always make sure that not all the capital allowance is being cleared. We will always be checking 2/3 of this to see if we will look for the capital allowance suitable for it. So we find out that this is 1,200,000. 1,200,000 is smaller than this. That's why we're taking the smaller. If assuming it was 2 million or 1 million, if it was something bigger than this, we would have taken the smaller value by repeating this. But this is big, smaller, so we put it here. I said we are going to put it here and also put it here. The reason why we are using it 2 times is not that we are doing it 2 times. This one here is, we are looking for how many capital allowance will be left remaining when we remove this 1, 2. It means 750 will be left remaining. Then, when we now apply that 1, 2 to reduce our profit, 600 will be our taxable profit. So it is actually here that we are applying the capital allowance, but we are also putting it here just for us to know the balance which will be carried next year. Now the balance is carried next year. This is the capital allowance for that next year. The one for the next year. This was one that came from the previous year. We add them together and we have a total figure. Now this is the profit for this year now. So we are now saying we are going to do 2/3 of this profit. And we got something smaller than this. And so that's why we are putting it here. We are also putting it here. We are saying by putting it here, if we take away this figure from this bigger figure, how much are we going to carry next year? Now, if we now apply this capital allowance to the profit, how much profit will be left for us to charge tax? That is the essence. Okay, now we'll go to the next year. This is the profit for the next, for this 2003. You know where we got it? Now this was the capital allowance we brought from last year that was remaining. So if you can see it here, we brought it from last year. Now this is the capital allowance alone for this year. When we add them together, we got a figure, this. Then we will now do 2/3 of our capital allowance, of our profit. When we say 2/3 times 3,500,000, what we have was 2,333,333, which is bigger than 1,446,660. So we will choose the smaller one. Choose the smaller one. So I will not choose the smaller one. That means repeating this capital allowance that is smaller than 2/3. So we now repeat it here, and we now repeat it here. So what we now did here is that if we take away this figure from here, how much are we going to carry to next year? Nothing. So nothing for next year. We'll now bring it here. We are now bringing the capital allowance to profit. When we deduct it, how many profit will be left for us to charge tax? So that's this. So we now go to the next year, 2004. We are doing something similar. And so this is our profit we brought here. Now, there is no capital allowance from last year because it was 0. And this is just the capital allowance for this year. And when we do 2/3 of this figure, we are getting something higher. So we say 2/3 times 1,500,000. We are getting 1 million. So because we got 1 million, which is smaller than 870, we are going to repeat our 870. So it means we will not carry anything to the next year. 870 will be here. We less it from 15, and we got 630 as taxable profit. We'll now go to the next year. There is no carry forward from last year. Our capital allowance for this year is 15. Our accessible profit is this. So when we look at 2/3, you always be doing 2/3 from beginning to the end. 2/3 times 1,700,000. You get 1,133,000. It's bigger than 870. So we take our 850. Then we take our 850 and we do the same thing here. Do the same thing here. Your taxable profit is 850. Now we'll go to the next year. The next year, we are not bringing any capital allowance forward. We have 730 as against 12. When we do our 2/3, we get something bigger. We bring our 730 here. It means no allowance is carried forward. That would mean that when we deduct the 730 from here, we have 470 here as our taxable profit from where we charge tax. Now let's go to the interesting point, the penultimate year. The penultimate year. Now, this is what we are saying. Penultimate year, look at the basis period for PYB. So I'm going to be looking at 2006 figure for accessible profit. 2006 figure is 950. That's fine. That is this 950. So notice here I didn't bring it to this side. It is here because I'm going to make options. I'm going to make a choice between accessible profit for PYB and that of AYB. Now look at AYB, penultimate year AYB, 2007 January to December 31st, 27. We cannot find December 31st, 27 here. But where can we find January 1, 27? We can only find January 1, 27 here because this is a period that has September 30th, 27. That means it must have started by October 1, 26, ending in September 30th, 27. That would mean our January 1 can be found here. So from January 1 to September 30th, when it's ending, is how many months? It's 9 months. So we are going to take 9 months out of these 12 months of 780. Then we will need 3 months now remaining to make it 12 months because it's a 12 months basis period. We are going to take the remaining 3 months from these 10 months here. So the 3 months are going to be October, November, December. They are all found here. So we'll now say 3 months out of 10. So what we'll do is this. We will first of all say 9/12 times 780. You have 585 on the one hand. Then you come and do the second one and say 3 divided by 10 times 250. You have 75 on the other hand. So when you add 5, 585 plus 75, you have 660. So that is how I got this 660. But we said the tax authority will forgo the smaller one and take the higher one. So you see, they are taking the preceding year basis. So that will mean that the capital allowance that matches with that one is going to be used. So if you look at it here now, this is the capital allowance that will match with the 2006 year. Sorry, is it 2006? It's 2007. So this is the 2007, the capital allowance. So if all the assets, if there's any asset that was bought in the actual year, you see, both the initial allowance and the annual allowance would have been incorporated. So the basis period would have been elongated. It would have been elongated to cater for that 24 months period or 15 or so months. So I think it's supposed to be 16, 24 months period, 15 to 24 months period in this question. So this is the base, this is the capital allowance that will be used for that period. So now if you see, this is our chosen basis period profit, which is this. And now this is the capital allowance, which is still 950. Coincidentally, it is still 950. Now, when it comes to the penultimate year, now we will now look at the basis, the capital allowance and the profit are the same. So no doubt, you have to do 2/3 of capital allowance to find how much to be relieved. So we are going to relieve this amount. This is 2/3, because when you do 2/3 of 950, you are getting this. And this is, of course, lesser than 950. So you put it here and you put it here. Now, because this figure and this figure are the same, that means this figure and this figure will be the same, because you are doing simple subtraction. So this means that this is your taxable profit. This means that this is the one that will be taken to next year. Now look at that next year. The next year is this figure. We'll come back to it. But look at ultimate year assessable profit. Assessable profit is actual year basis starting from January 1 to July 31st. Now, this is, they told us 10 months. Of course, you know that this would have started from October 2007, but we need from January 1 to 8. So from January 1 to July 31st is 7 months. So we are taking 7 months out of these 10 months. So that's why you are seeing 7/10 of that figure, which gives me this figure. That explains how we got 7/10 of the assessable profit. Now we come to the capital allowance. This is what was brought from last month or last year. This year, there is no capital allowance recorded here in 2008. But we were told that on the year of disposal, after disposing of all company's assets on cessation of business, that shows it was done in 2008, amounting to this amount. So this is a balancing allowance, which is also included in your capital allowance. That is only done in the year of disposal. So that year of disposal happens to be the ultimate year. So what will happen now is this: the ultimate, the asset disposal allowance and balancing allowance is brought here to add with this one. You will have a total of this. But see something here. You do not do 2/3 on ultimate year. Never do 2/3 of capital allowance on ultimate year. This is because even if you do 2/3, you are not going to carry it forward again because the business is ending. All you need to do is look at your profit and see if your profit is bigger than your capital allowance. If it is, clear all your capital allowance with the profit. That's it. Then you have no problem. But if your capital allowance is bigger than your profit, then you cannot clear all your capital allowance. Clear your capital allowance as much as the profit can carry. That would mean that if you have 2,660,667 and you have profit of 175, that means your capital allowance can only take 175. So clear all your profits. Let your profit be zero. That is the point here. Let your profit be zero. How will your profit be zero? It is you repeating what you have in the profit figure here and repeating it here. So you are clearing all your profits to be zero, taking it as capital allowance. So your profit is zero. You cannot charge tax again on zero profit, but you always charge your education tax as long as you have accessible profit. So now what happens when you put 175 here? This is the remaining balance, but you cannot take them forward. You take them backward. So you are in the ultimate year. You are going to take them backward to the penultimate year. So look at what I'm going to do now. I'm going to go back to penultimate year so that you see something. So, okay, let me still use this. Now let's go to, okay, now this is your penultimate year, right? If this is your penultimate year, let me still bring this one here to penultimate year. So that will mean that this is the same thing. Let's continue from here. We are now carrying it backward. How do we carry it backward? Now, what happened is this. Look at your penultimate year again. Can you see this taxable profit we have here? That is what I brought here. It is from here that tax was charged. But the principle is the tax authority will refund you your tax so that your tax will become your tax will be zero. So you see your tax will be zero. Your taxable income will be zero. They will refund you your tax so that you will use whatever profit you have to clear your capital allowance. The essence is to make your profit zero so that your capital allowance will be cleared. So if the essence is to make your profit zero, it means that look at this capital allowance here. It is this capital allowance that was carried backward. So that is it here. So now it has been carried backward. It is still bigger than your profits. So that means you have to remove all your profits and take them as capital allowance to clear your capital allowance. So you are clearing all your profit as capital allowance. You are having zero here. This means this is the amount you are taking backward to the next year. Another way of getting this figure here, in case you were not given, this figure, you know that if they only give you tax, you know that tax is 30% of taxable profit. This thing means 30 over 100 of taxable profit. If they give you tax, all you need to do is this tax figure times 100 over 30. You see, here is 30 over 100. Here will be 100 over 30 of this 95,000. You are going to get this. So if you are not giving this, but you are giving tax, just say 100 over 30 of this figure, you get this. Simple. So now that we've given that, that's fine. Now we'll go to the next year. This figure, now look at it here. It is this figure, or sorry, it is this figure, exactly this figure, or 100 over 30 of this figure. So what happens is you bring this one backward down here. Bringing it backward means, okay, you are bringing it to this here to see if you can clear it, but it's still the profit. So the profit is not enough to clear everything. So clear as much as the profit can carry. So it's still zero. This one will be going back again. That will mean that the 141,000 I was previously paid will be refunded to you. Okay, you now took it back again. When you took it back, this is your profit. This is the backward, carried backward. It's still bigger. You remove everything. This is what is left. That means whatever tax you've paid before is refunded to you. You now take it one more step backward. This is the fourth year you're taking it back. So this is your taxable profit 630. Now this is the one you brought back. It's still bigger. You now remove your 630. This is the remainder that you carry backward. No company income tax, no taxable profit. Now this is the last year you are going to carry them backward. So let me bring it down back to you, 2003. So if you remember, it started from 27. So you said 27, 26, 25, 24, and 23. This is the 5 year you are carrying them backward. So 23. So can you see 23 here now? My system is freeze now. Okay, can you see? What is happening? Now, can you see your taxable profit here? Ouch! Why is the system hanging? Hold on a moment. Okay, now this is your taxable profit here. As you can see, 2,113,000. This thing is freezing. $2,113,333. This is your taxable profit, which is still the same thing here. That's fine. It is still the same thing here. Now, your capital allowance is carried backward. So now, can you see that this profit is bigger and big enough to clear this capital allowance? So all you now do is you clear everything. You don't do 2/3 when you are carrying backward. You don't do 2/3. So now you clear everything, and this is the remaining taxable profit. So your tax will be based on this and not on this. So you are going to be paying a tax of this figure instead of the tax of 604, which you were charged. That will mean that they will refund you some money, not all. They will refund you some money for tax. This is the amount they are going to refund you. They are going to refund you 65,700, because if you do 65,700 times 100 over 30, what you are getting is 225. So they are going to refund you a tax that is equivalent to the capital allowance you want to relieve for that year. So you see, that's it. So your tax is just going to be 536,000. So it's going to be 536. Is it 5? Sorry, it's going to be 538,300. That is what it's going to be. It's a mistake. 538,300. So you just help me and adjust it. So that is how it is. So now look at the summary of tax that is going to be paid. In 2001 down to 2008, look at the tax. This one was untouched. This second one was untouched. This third one is 538,300. Please Previously, it was 604. If I have known, I would have written previously and now. Now, this is previously 604, but now 538,300. Previously, there was a charge here, but now it's 0, 0, 0, 0, 0. So you see, it starts counting from here. The 2008, the ultimate year, will always have 0 if you have a higher capital allowance unrealized. You must have 0 in that year. Then in the 2007 penultimate, you see where your 0 starts. 1. That's when you start counting back. 1, 2, 3, 4, and this is the 5th one. If you had 0 here and you have unrealized capital allowance, that means you cannot take it backward anymore. That would have lost forever. So nothing would have happened here. Nothing would have happened here. So it's possible that you can have 6 zeros. Okay. Now, I've told you that other years you'll be prorating it to third. But when it gets to final year, don't prorate. It says 536,500 by your calculator. Okay, anything that is in your calculator is fine. It's okay. So choose the correct answer. Maybe one of them is a mistake, so no problem. Choose the one that is correct. So you have to prorate, but when it gets to the last year, don't prorate because you want to clear off all your capital allowance. That's fine. Second thing, when you are doing your backward movement, don't prorate. You are only bringing your profits that you were charged tax from to clear off your capital allowance. So you see, this is a classic example. I want you to also go back and study similar example like this. This is a past question. For the past how many years? 7 to 10 years. This is only once they have brought a question on backward carried of capital allowance. It may come again. It appears once again in the previous syllabus that ended in November, that ended in May 2014. The previous syllabus that ended in 2014 May, it appeared once. The just immediate past syllabus that started from November 2014 and ended in May 2019, it appeared once again. So study this example and this other one in the past question and see how you can tackle it. Now, if you study this example, you will see a classic example of also how to do your capital allowances, how to do your basis period for profit and carry back. So this is just a good example. Also, look at the question trend which I sent to you. Look at it and see how you can see capital allowance questions. Every capital allowance question always lends itself to basis period. So use capital allowance to learn basis period. You can also learn basis period from basis period, commencement, cessation, change of accounting date. That's fine. Also learn capital allowance. Also know in exam that if you are asked to compute capital allowance, that is a time waster. It takes lots of time. So just do as much as you can, stick to your time and leave the rest because you will not be wasting the whole time on capital allowance. So look for a way to be efficient, how to be very fast in computing capital allowance. You can only be fast by practice, practice, practice. In our next class, which is on Tuesday, we are going to look at income of business, which is loss relief. We are going to do loss relief and we are going to do some other things for that period. So we are going to enter loss relief plus the topic for that day. So thank you so much. If you have any question, you can leave it on the WhatsApp forum. Thank you so much for joining the class. And I believe when you combine this with the resource I sent on the WhatsApp group, the voice notes, everything will become clear for you and you will have no problem with this topic. All right. So thank you so much for coming to class. Do have a nice day. See you in the next class. Thank you.